Imagine juggling several debts at once. A credit card here, a store balance there, a small personal loan, each with its own due date and its own interest rate. The mental weight can be heavier than the money itself. Debt consolidation promises to simplify all of that into one payment. It can be a real relief. But it can also hide the deeper problem. Let us slowly unpack it. A debt consolidation loan is a single new loan used to pay off multiple existing debts. Instead of owing several lenders, you now owe one. You take the consolidation loan, use it to clear the smaller debts, and then repay that one loan over time. The appeal is simplicity, and often the hope of a lower overall interest rate or a more manageable monthly payment. The simplest benefit is mental. Many people fall behind not because they cannot pay, but because they lose track. Multiple due dates, multiple statements, multiple minimums. Consolidation reduces that chaos to one date, one payment, one number to watch. For someone overwhelmed by complexity, that clarity alone can make the difference between staying on track and quietly slipping behind. The financial benefit depends entirely on the interest rate. If your existing debts carry high rates, and the consolidation loan carries a meaningfully lower rate, you can pay less interest over time. But if the new loan's rate is similar, or the term is much longer, the math can quietly work against you. So the rate and the term are the two numbers that truly matter. Let us walk through a healthy example. Imagine someone has several high-interest debts. They qualify for a consolidation loan with a clearly lower rate and a reasonable term. They use it to pay off everything else. They then make steady, fixed payments and, importantly, they stop adding new debt. Over the loan's life, they pay less interest, finish faster, and feel calmer along the way. Now the unhealthy example. Someone consolidates their debts, feels relieved, and then treats the freed-up credit cards as available money again. Within months, the old cards are full once more, and now there is also the consolidation loan. The debt did not shrink. It multiplied. This is the single most common way debt consolidation backfires, and it is about behavior, not math. This is the central truth about consolidation. It is a tool for organizing and possibly cheapening debt. It is not a tool for eliminating the habit that created the debt. If overspending caused the original problem, consolidation without a change in spending simply resets the trap with a cleaner appearance. The loan handles the symptom. Only you can handle the cause. Let us look at the different forms consolidation can take. A common one is an unsecured personal loan, which is not tied to any asset. Another is a balance transfer onto a single card, which is its own strategy. Some people consolidate using a loan secured by an asset, like home equity. Each form has different costs, different risks, and different consequences if things go wrong. The secured option deserves special caution. When you consolidate unsecured debts, like credit cards, into a loan backed by your home or car, you may get a lower rate. But you have also changed the stakes. If you fail to pay an unsecured debt, the consequences are serious but limited. If you fail to pay a secured debt, you could risk losing the asset behind it. There are also fees to watch for. Some consolidation loans charge an origination fee, deducted up front. Some have prepayment penalties, which charge you for paying off the loan early. Before signing, you want a clear picture of the total cost, the interest, the fees, and the full amount you will repay over the life of the loan. The advertised monthly payment is only part of the story. A longer term is a quiet trick worth understanding. Stretching the same debt over more years lowers the monthly payment, which feels great. But it can also mean paying more total interest, even at a lower rate, simply because you are borrowing for longer. A smaller monthly payment is not automatically a better deal. Always ask what the full repayment adds up to. There is also a credit score angle. Applying for a consolidation loan may cause a small, temporary dip. Once you pay off the old revolving balances, your credit utilization can improve, which may help over time. Making steady on-time payments on the new loan also builds a positive record. The score effect is usually modest compared to the structural benefit of simplification. So who is a good candidate for a debt consolidation loan? Someone with multiple debts, a stable income, a decent enough credit profile to qualify for a genuinely lower rate, and the discipline to stop borrowing afterward. For this person, consolidation is not an escape. It is an upgrade to a clearer, cheaper structure that supports a payoff plan they were already committed to. And who should be careful? Someone whose debt grows from ongoing overspending, someone with unstable income, or someone who would only qualify for a rate similar to their current debts. For them, consolidation may add fees without solving anything. They may need budgeting help, a spending plan, or guidance from a reputable nonprofit credit counseling resource before taking on a new loan. If you do choose to consolidate, a few habits protect the plan. Close or freeze the temptation by storing away the cleared cards rather than using them. Automate the new loan payment so you never miss it. Build even a small emergency buffer so a surprise expense does not push you back onto credit. And track your progress, because visible progress keeps motivation alive. Be cautious of anything that sounds too easy. Be wary of companies that promise to make debt disappear, charge large upfront fees, or pressure you to stop paying your creditors. Genuine consolidation is a straightforward loan, not a magic erasure. If an offer feels secretive, rushed, or too good, slow down and verify. The honest options rarely need dramatic sales pressure. It also helps to compare consolidation with simply doing nothing different. Sometimes a focused payoff strategy on your existing debts, like attacking the highest rate balance first, works just as well without a new loan at all. Consolidation is one path, not the only path. The best choice depends on your rates, your discipline, and how much the mental simplicity is worth to you. So here is the short version. A debt consolidation loan combines multiple debts into one, ideally at a lower rate and always with simpler management. It helps organized, disciplined borrowers and quietly fails those who keep spending. Check the rate, the term, the fees, and the total cost. Then pair it with a real change in habits. The loan simplifies the debt. You still have to finish it.